True or false? An allocation to gold would have helped you outperform the global index market over the last 20 years. Hi there, my name is Chaz and I'm the Risk On Investor. This channel is documenting my journey to putting a £1 million investment portfolio. If that's something that interests you or a journey that you're on yourself, hit the subscribe button below to be notified of more content. Before we dive in, I just want to say I'm not a financial professional. If you need financial advice, please seek guidance from a paid professional. Nothing on this channel should be considered financial advice. So if you guessed true to that first question about whether a 20% allocation to gold would have helped you outperform the market, then you were correct. Not only did it help outperform the market, but it reduced the worst drawdown year, which gave you a better Sharpe ratio or a measure for risk-adjusted returns. But what if we change the picture to the last 10 years? Well, things change. In that instance, gold wouldn't have helped you outperform. So should we be investing in gold? So in this video, I'm going to cover 3 topics. The first is what actually is the reason for gold in your portfolio. The second topic is should you invest in gold? I'm going to give 3 reasons for. And the third topic is reasons you shouldn't invest in gold. I'll give 3 reasons why you shouldn't as well. And at the end, I'll share my personal thoughts and what I'm doing. So what's the purpose of gold in a portfolio? If we wind the clock back, gold has been used as a way of transferring value from person to person for around 2,500 years now. In around 500 BC, the first gold coins were struck in what's now modern-day Turkey. From those original coins being struck, right up until 1999, when the Swiss franc left the partial gold standard, currencies had always been backed by some form of commodity. So why was gold really well suited to this use? Well, gold itself isn't actually that common, and finding large deposits of gold is even rarer. That means that the new supply of gold every year doesn't actually grow by that much, because we physically can't mine enough gold to grow the supply of it quickly. That means that historically, gold has been a good way of transferring value because we know it's difficult for someone to counterfeit that gold and just create lots of new currency. It becomes a central thing that we can all trust. And due to that low new supply being mined every year, we can guarantee that the amount of gold isn't inflating away. So where central banks across the world target a 2% inflation rate, that means your currency is debasing at around 2% per year. The idea being then is that gold will hold its value against that currency debasement. So it will go up in nominal terms, but should give you that hedge against inflation. So why invest in gold? So I've come up with my top 3 reasons why you should probably consider an investment in gold. The first is one that we've just touched on, and that's as an inflation hedge. So because the new supply of gold isn't increasing very rapidly every year, that means that theoretically it should hold its value in terms of the goods it can purchase. So its nominal value would go up as currencies are debased over time, but in terms of if you are buying 1 loaf of bread with 1 ounce of gold, that should theoretically stay fairly similar as a ratio. We've also seen that historically, in periods of really high inflation, gold has actually not only returned a high nominal rate, but actually returned a really high real rate, with the real rate being the nominal rate subtracting the inflation rate. So the second reason you should consider gold for your investment portfolio is that it's a flight to safety asset. So that means when there's market turbulence or big geopolitical events that are uncertain, gold has historically done quite well in those situations. A prime example of this is the subprime mortgage crisis, where stocks took an absolute beating, but gold held up really well. So the third reason you might consider holding gold in your portfolio is that it has a low correlation to stocks and bonds. So we can see in this matrix that the correlation between gold and stocks is around 0.08. Now a 1 would mean that everything moves in lockstep, so if stocks went up 5%, gold would go up 5%. -1 would be an inverse correlation, so if stocks went up 5%, gold would go down 5%, and 0 would be uncorrelated. So in the ideal world, we would mix assets together that typically go up in value, but that also have a low correlation. The reason for doing that is that it can smooth out the portfolio returns that we receive, because if one area of our portfolio gets battered, another area will pick up the slack, and vice versa in the future. So that's 3 high-level reasons why you might consider investing in gold. But what about not investing in gold? What are 3 reasons against investing in it? So the first reason that we might not want to invest in gold is a reason that was popularised by Warren Buffett, and that's that gold isn't a productive asset. So normally when we're talking about a productive asset, we're talking about something that's trying to return value to you as the holder of that asset. That could be a rental property, where you rent it out and you get a monthly rent payment from the tenants. It could be a company that you own shares in, where that company might pay out a dividend or might carry out share buybacks to try and increase the value of their share price. So those assets are actively putting money into your pocket, whereas gold isn't. Gold is just a physical item that sits there and often has storage costs associated with it. So the second reason that you might not want gold in your portfolio is tied a little bit to the first, and that's that gold is purely based on speculative price. So whilst there is some underlying value to gold in that it's used for jewellery and electronics, in terms of an investment, the price of gold is driven purely by the greater fool theory, i.e. to make money with gold, you generally just need someone who was willing to purchase it at a higher price than you bought it for. And that's because gold doesn't have that intrinsic returning money to your pocket that we talked about when we talked about a productive asset. And the third reason is the absolute returns of gold. So I was a little bit cheeky at the beginning of this video when I suggested that adding gold over 20 years would have made your portfolio have a higher return. And that is true, but if we zoom out and look at a chart over the last 100 years, sorry if you're looking at this on a small screen, it might be difficult to read, but we can see that from the red line, that's the S&P 500, and the gold line is gold. So we can see that over 100 years, simply holding a selection of the 500 largest companies in the US would have far outperformed just holding gold. So what's my take on all this? Well, I personally don't hold any gold in my portfolio. The reason being that I would mostly consider gold if I'm looking to minimise drawdowns and volatility in my portfolio. And because I'm not drawing on my portfolio at the moment, I'm less concerned about what's known as the sequence of return risk. So that's the idea that once you start withdrawing on your portfolio, if you have a really bad few years at the beginning of your drawdown, that's much more likely to result in you running out of money than being able to live off your portfolio. But because I'm in the accumulation phase, I'm more interested in total absolute returns. I can stomach the volatility if it means I'll have a bigger pot later. So if you're fairly new to investing or just want to learn a bit more, I've actually got a free beginners investing course, which is a 7-day free email series that you can sign up for that delivers a new topic into your inbox each day for a week. It covers topics such as passive versus active investing. It also reveals how I made over a 100% instant paper gain on a trade that I made. And it also covers some of the more boring things like tax efficiency in your accounts. So if that interests you, I'll leave a link to that in the description below. In the meantime, you might enjoy this video. This is a video about a fund that I found that I consider to be even better than just investing in a straight S&P 500 index fund. It's outperformed over the last 50 years, and it gives you some of that volatility protection without including gold. If you found this video really helpful, please hit the subscribe button below. It really helps small channels like me grow and get noticed. And if not, I'll see you in the next video.